1% increase on the interest rate. That's crazy. What we have here right now is like people panicking and thinking what's going on. Hi, everybody. It's Katrina with Katrina and the team at REMAX 2000. And here with me today is Christian Amurao with Open Doors Mortgage Team to shed some light, put some clarity, and kind of like put things into perspective and not just panic. So Christian, let's talk about this 1% increase on interest rates. Tell me more about it, because what is it really like? What went up? Like, because there's different kinds of interest rates. So give us clarity, give us some information about what happened.
Okay, so just for clarity, what the Bank of Canada decides on is the overnight rate. So what an overnight rate is, that's the rate that the Bank of Canada set, and that's what the banks use to borrow money from each other. Okay, and what it means for us as consumers or borrowers is that overnight rate affects or influences or directly related to what the prime rate is. So prime rate is what is our personal loans or mortgages or lines of credits and other stuff that's direct to the consumer effect is that prime rate. So as the overnight rate changes, so is the prime rate. Okay. So when the Bank of Canada announced their rate increase yesterday, which is that 1%, basically what it does is it affects the prime rate for the borrowers who's got mortgages and loans and lines of credits. Why, as far as why they increase it, I mean, from the previous months, the expectations were about 0.5% to 0.75%. So basically what they're doing is it's called front loading. What it means is rather than increase it little by little, they increase it much more than what's expected. And the reason, let's rewind back. Why are they increasing this prime rate? Okay, so right now, Bank of Canada's main concern is keeping a hold of this inflation rate. And what inflation rate is, it's the rate of change. So for example, you know, how groceries are more expensive now, like from the cost of milk and eggs and all that other stuff. And also gas, for example. Like you see how dramatic or rapid the increase is. And now our inflation rate is over 7%. So that's very high because our target or the government's target is about 2 to 3%. So we're more than double what the inflation rate is, or what the target inflation rate is. So now for Bank of Canada, their job is to moderate that or to control that or somewhat influence it in a way. So but the way that they can do it is by increasing the rate or the prime rate or overnight rate. And then basically what happens is as they increase the rate, everything will slow down in a way where spending slows down. And then if spending slows down, the demand slows down, which kind of meets the supply. And then the inflation stabilizes. That's their whole idea of this rate increase. And basically why they went with the 1%, because for the previous year and a half during the pandemic, they pretty much held off on whatever the rate is because they didn't want to touch it because they don't know how the pandemic's going to play out and this whole supply chain issue. And now they're basically trying to catch up now by increasing the rate little by little over the past few months. Actually, little by little is an understatement because they've been increasing it 0.5%. Yeah. Statistically speaking, over the past 15 to 20 years, they've only been increasing about 0.25 at a time, right? But with all these unprecedented times that we're facing with this overly high inflation rate, they have to really go over aggressive. They have to be aggressive a little bit is what they're looking at it to basically control this inflation. So they front loaded it by 1%, a whopping 1%, so that they won't need to keep increasing it and or to make that bigger impact up front. The goal is to basically lower this inflation rate. And you know, this inflation rate will ultimately control or minimize the consumer spending and then matches the demand and then stabilizes the inflation. So that's the whole game plan and strategy that they're going for here. Does that make sense?
Yeah, totally. It makes more sense. And really, it kind of like, there's so much reaction, there's so much frenzy going on about it. And like, I get calls from other realtors, like, that clients are panicking. So other realtors, we also have clients who are concerned, not necessarily panicking, but more concerned about what this looks like for them. But before we go there, also putting things into perspective, I mean, the government lowered the interest rates during in the beginning of the pandemic, during the pandemic, also because they didn't know what to anticipate as far as keeping the economy going.
Exactly.
By lowering the interest rates before, during, like, the first year of it was around the first year of the pandemic, they lowered the interest rate, so then people will not be scared to spend. And then lots of things happen. Definitely a lot of it, it's macroeconomics, right? Lots of things happened. I mean, supply chain issue being the biggest one of the biggest one, if not the biggest one. Plus people then spent more money. So it kind of like, we kind of went too extreme and like too much that, things kept going up and up. And now we got to a point that it's time. It's time. So what does it look like right now? Like, what's the prime rate? Is that like, I know it's different from bank to bank.
Well, most banks' prime rate right now is at 3.7, but effective, I believe, if not today, midnight tonight, it would be at 4.7%. Okay, but to give you a perspective, back in 2018, end of October, end of 2018, prime rate was sitting at 3.95. And that time when we were starting to get, the economy is getting busier, that's kind of like the upward trend. But then pandemic happened, then it went down to 3.45 in 2020, and then 2.95. So it kind of dropped, and then it's starting to creep back up now to, I mean, prior to yesterday's announcement, the prime rate was basically back to what it was back in 2018, right? But now with this whole inflation rate issue that we're facing, it is now it's now 4.7%. Now TD has a different prime rate, slightly higher prime rate, which is 0.15%. So they're sitting at 4.85%, but they mitigate that by giving bigger discount, which equalizes the net rate for the borrowers, basically. But generally speaking, the prime rate that we're looking at right now is 4.7%.
Okay, so now still on this interest rate talk about, okay, that's the prime rate. People who are affected by it are people who carry a variable mortgage.
And also for the line of credit, so people who have lines of credits. Yes.
Yeah. So for the most part, as it relates to me, you in real estate and mortgage, so it affects people who have. It also affects people who has loans that's attached to the prime rate.
Correct.
So, but for us, it's people who have mortgages.
That's on a variable rate.
That's on a variable rate. There you go. That is on a variable rate. And
if you're on a fixed rate, then you don't need to worry about what's going on, right?
At the moment,
it stays the same at the moment, right? So
yeah. So people who locked in their interest rates, they're okay, because then you're locked in, meaning even if prime rate continues to go up, if you're locked in for 5 years until your term is over, your
payment still the same.
Yeah, your payment stays the same. Good.
Right.
So how does this really affect right now? Like, okay, let's talk about, there's two different portions that I'm talking about. Current people who are homeowners who have a mortgage, like let's kind of put some numbers in it.
Sure.
And then people who are looking to buy, how does that affect them, who are in the market looking to buy? Now the interest rates went up and they're like now scared. So, and even like, they're like, oh my gosh, can I still afford it? How does affordability look like with this increase? So let's start with the current homeowners who has a variable mortgage.
All right. So for current homeowners, there's basically three options, right? The most obvious one is locking in. Is this a good option for you, right? And so if you're on a variable rate, you can lock in into a fixed rate mortgage term with no penalty. Now, what we're seeing right now is the lock-in rates are in the about low 5%, maybe sub 4, depending on the remaining term or the term that you're locking in. And if just to give you some perspective as far as the numbers, because at the end of the day, I think talking about an actual monthly payment is what a lot of people can relate on, right? So if you lock in right now, let's just say for every 100,000, and if you lock it into a fixed rate right now at around low 5%, your payment will increase about $300 if you lock it into a fixed term of about 5%, right? So for every 100,000, it's about $300 per month more.
If you lock it in.
If you lock in, yeah.
So, okay, step back a little bit.
Yeah.
We're talking about comparing the new prime rate, whatever discount they have, or whatever it is, that if they're on variable with the increase versus locking in. That's what you're saying, right?
What I'm saying is whatever their current rate is right now, if they lock in, it's going to be about $300 more per month per 100,000. So if
Okay.
their current rate is at 2.8%, for example, and their monthly payment is for $100,000 mortgage, if their monthly payment is about $600, if they lock into a fixed rate, same mortgage amount, about 100,000, and the rate is now 5% from 2.8, their payments is going to be $900. So that's about $290 per month difference. So let's round it up to 3 just so it's easier to calculate for a lot more people. So if you lock in your current variable rate, I didn't even factor, we're not talking about the increase in rate yet.
Okay.
This is from before the 1% increase, right? Because the 1% increase, I mean, we'll talk about that in the next one. But if you're currently on a variable rate, because the payment's not going to kick in until next month anyway, so they won't know what they will be advised what the new monthly payments will be in the next few weeks here. But with their current payment, it will increase about $300 per 100,000.
Per 100,000 on a 25-year or a 30-year?
That's on a 25-year, but then if you're on a 30-year, it's going to be roughly the same.
Oh, okay. So, okay, so that now let's not think about, okay, if they want to convert, so because that gives them an opportunity. If they stay in the variable,
there you go. So that's the next one.
What is how does the increase affect their monthly payment?
Yeah. So if that's the second option
for me.
Yeah. So that's the second option is so first option is locking in, right? For those people who currently own a property who has a variable rate mortgage, option 1 is lock in. Option 2 is stay on a variable. So if you stay on your variable rate, I mean, there's different mortgage products out there. There's the adjustable rate mortgage and there's a variable rate mortgage. But the idea of the variable and adjustable rate mortgage is the mortgage rate changes based on prime rate, right? So if the prime rate increases, your rate increases. If the prime rate decreases, your mortgage decreases as well, your payment, I mean. So one product is the adjustable rate mortgage is basically as the rate changes, the allocation between your fixed your monthly payment is the one that changes. Okay, so your payment stays the same, but how much goes to principal versus how much goes to interest is what's being changed. And I look basically, if the rate increases, the interest rate will be more compared to the principal. Whereas if the rate decreases, then there's more to principal, there's less on interest, your payment stays the same. It's called the static payment, basically. Whereas the other mortgage, the other variable rate mortgage is basically as the payment increases, as the interest rate increase, your payment will increase accordingly so that it maintains the portion that goes to principal and the portion that goes to interest. Okay. So that said, if you are staying on course, if your mortgage is on a static payment, then that means your payment stays the same. The only difference is how much is going to principal and how much is going to interest. And then if you're on the other mortgage product where your payment changes, then that means your payment will increase accordingly, which brings me to my next point, that when with the 1% rate increase per 100,000, so it would expect an increase of about $121, roughly 120. Let's call it 125 just to be safe. Approximately $125 per month, depending on your interest rate for sure. And so if you stay on variable rate, expect your payment to be increasing about $125 per month per $100,000 of mortgage. So if you have $200,000 mortgage, it would be times 2 of 125, then that's $250 a month. Okay. So that's the option. The second option for a borrower who's got a variable rate mortgage. Now there's a third option that we can basically restructure their mortgage, and kind of depends on the overall qualification, the equity position and all that, or the remaining amortization. What we've been doing also with other clients to help them with their cash flow is basically, if someone who's been in their property for a while and they pay down their mortgage and they've been there for about 5 to 10 years and the value's gone up, what we tend to do is just kind of restructure it in a way where we can, it's called the reamortization the mortgage, which makes the mortgage a lot longer. You say, for example, if they paid it down to 20 years, we can re-extend it to 30 years, which will cause the monthly payment to decrease. Right? It all depends on everyone's financial goals and financial situation. I mean, if monthly payment is the big pain point right now for a lot of people, that's one option that they can do.
Okay. That's a lot of information. So it's really important to, have a conversation with the mortgage with the mortgage broker. So then, because each person is different. Now, one question that I thought about is, if you were on this, the variable where the monthly payments changes as the variable rate changes, can you actually switch to that static one?
That one is a more specifically lender base. So I mean, TD is one of the lenders that have the static payment. And like for us to change that, it basically will need to move from one lender to another, which will trigger some penalties and costs. But it all depends on what is the bigger picture here. Like, we have to look at, what are we trying to accomplish? What is the cost and what is the benefit? Like, which one is better, right?
Overall, long term also. So that's really, really important right now, because some people are concerned, because the other part of that question is, well, okay, if I lock in now, even though I'm willing to pay, I'm gonna pay more anyways because of the increase. But are we foreseeing that it will continue to increase again? Am I really better off locking in?
Sure. Sorry, quickly, I just realized I just flipped it the other way around. ARM mortgage, or ARM, or adjustable rate mortgage, is the one that adjusts the mortgage payments, and variable rate mortgage is the one that adjusts the payment static. Okay. But to answer your question, are we seeing, I mean, based on Bank of Canada's statement, there might be another increase in September, right? And by how much, who knows? Because right now, I mean, at the end of the day, it's like Bank of Canada is still monitoring how this announcement will affect inflation. Because really, like, they're basing it on lagging indicators, meaning they will see what the results are, and then they look at what it is, and then do they decide, okay, well, do we adjust some more or do we keep it the same? Right. So right now there is a higher indication that they might increase another 0.25%. Right. Mind you, they did 1%, the front loading term that I use, so that they might not have to, or they might have to increase it by 0.25% by September, and who knows, by next year they might decrease it. Right. It all depends on where this inflation rate is sitting. So there is no right or wrong answers as to you should lock in or not. Like, every situation is different. The whole idea of being on a variable or adjustable rate mortgage is the flexibility that it provides, that it guarantees that the prepayment penalties are a lot more cheaper, or it also allows you to experience, yes, right now you're experiencing the increase of interest rate, but also will allow you to increase the decrease of interest rate down the road. Because if you lock in, then you're locked in, right? So whatever rate that is that you lock in at will be the rate that you're committing to for whatever term that it is. So either 5 years, 3 years, or 4 years. Right?
Yeah. So, and that too, if you do lock in and you plan on moving in the next 3 to 5 years, that means your penalty also may be higher than what it would have been had you stayed with your variable rate.
Yes.
So it kind of offsets that.
Granted, there
savings.
Yeah, exactly. I mean, granted that, if you're on a fixed rate, there is also the portability feature of it. But the portability feature will also affect your qualification altogether. So it's not as, I mean, portable. I mean, banks tend to market that as a feature for a mortgage, but what it boils down to is, again, it goes back to the qualification, right?
Mhm.
So, you know, like sometimes it is, so it depends on the strength of a client, but for the most part, like the portability feature will also have its own limitations and restrictions.
Yeah, yeah.
Right. So segueing to that would be, I think part of what you mentioned earlier is, sorry, I think we can go over the like, how does that affect? Because I think I mentioned qualification, then we can kind of go back to.
Yeah, so it's kind of like the same thing. If you're buying now you don't have a mortgage yet. It's the
Mhm.
same thing. It's like, if you want to switch, right? So now, what about current home buyers? People who
Mhm.
had the pre-approval, people who are looking but have not necessarily bought yet. Now they're hesitant. How does their pre-approval look like with the increase?
It's a great question. Every lender, when they're pre-approving, there's some lenders that once you're pre-approved, they will base it in on their previous qualifying rate that they used. Some
Mhm,
lenders will use it based on current qualifying rates. With
mhm,
this prime rate, because there's a so-called benchmark rate, which is the 5.25 qualifying rate that we normally use. But with this rate increases, that benchmark rate is no longer the benchmark rate for us to qualify, because the rule is for the bank, it's for someone to qualify, they will qualify either on benchmark rate or the contract rate plus 2%. So the
that's the
benchmark,
stress test, right?
yes, that's a stress test.
Okay.
So what a stress test is basically saying is, so for example, over the past few years, the rate has always been around 2%, right? Like a couple of years ago, it's pretty low. So what the stress test did was, the bank is based, or the economy as a whole, or Bank of Canada, or OSFI is the regulator, basically said like, okay, well, we want to make sure that people can still afford their mortgage if rates do increase. Situations exactly like this. That's
Mhm,
why, people can still afford to pay their mortgage and still afford to go on vacation,
mhm,
because to qualify for a mortgage, they basically say, well, we know you can afford this payment, but your actual payment is here. So even though the rate increases, we know that you can still afford it. So that's what the stress test is.
yeah.
But in regards to the qualification side of things, with this 1% rate increase, it pushes that qualifying rate a little bit more. Because, for example, right now, if the prime rate is at 0.7%, and the best 5-year variable, let's just say at prime minus 0.9, right? So if the prime rate is at 4.7,
4.7. I was like, 0.7?
yeah, 4.7, then your contract rate is going to be 3.8%. So that's 4.7 minus the variable rate discount of 3.8. So, oh, sorry, 0.9. So your actual contract rate, the monthly payment would be based on a 3.8%.
Mhm.
But for the stress test rule is 3.8% plus 2% is 5.8. That's your qualifying rate. Basically, that would, to make sure that you can still afford the payment if the rates increase, right? So
Mhm.
now, from someone who's qualifying from 5.25 to 5.8%, there's that gap of qualifying, where now, to answer your question as far how does that affect someone's qualification, it does have some effect. I've seen it ranging from 5% to 10%, but let's just say on average, from what we've been seeing on our end, is about 10% decrease in their qualified amount.
So let's just say someone is qualified to borrow money at, you're going to use an easy number. So 600,000, that's the money they're borrowing, not the purchase,
Mhm.
but that's the mortgage they're pre-approved for. So if
Mhm.
it's 600,000 on average, the tendency is they're probably going to qualify for with the new rate,
Yeah,
540,000.
correct.
That's if they're pre-approved and they pick the variable rate.
Yes, but keep in mind, like, even if they pick the 5-year or the fixed rate, the
Mhm.
qualifying rate on a fixed rate is higher, because if the rate right now is 5.09, they're qualifying at 7.09. It's
Mm,
always the plus 2%. So
mhm,
that's why, if you are qualifying and you're trying to qualify for a higher amount, go in a variable rate so you can qualify for a higher amount, right? And then you
mhm.
can lock in after that. But there's a chat and a discussion that needs to be have in regards to which one is which, right?
Yeah.
So to maximize our qualification, the lower qualifying rate right now is if you go on a variable rate.
Yeah. Okay. Okay. I got it. I got it. And I hope you got it. We're going to try and we're recording this video and we're going to try and see what we can do to make it, because numbers can be confusing.
Yes.
And at the end, it's just what we're trying to do is give more clarity and a little bit more, put things into perspective, because it's like some people are running around like the world is ending. And really, I've seen this rate before. I mean, yeah, pre-pandemic, it's almost similar to pre-pandemic. Now it's creeping up higher.
Yeah.
But I don't know if you can remember, when was the last time we saw prime rate at this level? Do you know? Like, can you remember? I mean, I know you know it.
Here, actually, I was looking at it. The last time that the prime rate was at 4.75 actually was in 2008. This is prior to the credit crisis in 2009 and 10, right?
Mm-hmm.
Back in 2007, prime rate was as high as 6.25%.
Mm-hmm.
So relative to 2007, fast forward to today at 4.7, it's not that bad, right? So in 2007, prime rate back then was 6.25.
Mm-hmm.
Now, fast forward to 2022, it's
Mm-hmm.
4.7.
Yeah.
Right?
Well, and that was the last time I remember that clearly, because I remember the effects of the changes, and the government has since put in a whole lot more kind of like security features to protect us consumers, to protect people from going through financial crisis. I mean, during that time, back in 2007, there was a 40-year amortization mortgage. You can
100% financing.
yeah,
Zero
exactly.
down, right?
You can buy a house with no money,
Yeah.
and there's no skin in the game. And so what happened in 2008 is that people overextended themselves, that we saw a good number of foreclosures. Now, also, to put things into perspective, it didn't go as crazy as it did in the States, because the States, they had a crash. We
Yes.
had a soft landing.
Yes.
And so for the most part, the government has changed the number of the amortization years from 40
Years.
down
Yeah.
to 25 for high ratio mortgage and 30 for the most part
Yeah. And then
conventional.
30 for conventional.
And then they have put in the 5%. Well, there's always been the 5%. No, they added the 5% minimum down payment required. And then the refinancing part, where we cannot borrow more than
80%.
of the value of the property up to a certain amount. Of course, there's different.
Because back then you were allowed to borrow up to 90 or 95% back then, right? So
Yeah.
now they cut it back to 80%.
Yeah, up to a certain amount of value. So that's another one. And then more recently, they added the stress test to protect us. So those measures and a few other ones allow, and also decreasing the loan to like that ratio where we're allowed to borrow money against
debt
our
servicing ratio.
debt servicing ratio. They also made that more stronger. So then we're not borrowing up to our neck and overextending ourselves. So those protections were put into place for times like this, because they have to increase the rates, because someone has to pay for some of the things also. It has to be, and mainly macroeconomics is to also control that inflation, because it's, even if they didn't increase the interest rates, what's going to happen is just people are just going to keep spending, and interest rates will, the cost of things will just continue to go up. So I hope that kind of made sense. That's how I got it. That's how I took it. And so overall, as far as someone who has not bought yet, if they're looking to buy, look at their pre-approval amount. It may have gone down. Talk to you, the mortgage broker. If anyone has any questions about this, if they want more clarity as it relates to their specific situation, they can give you a call.
Sure.
Yeah.
My recommendation is for anyone who's been pre-approved, number one, and actively looking for a property to buy. I would recommend you to reach out to your mortgage brokers, or if we did your pre-approval, please reach out to us and get an update, like get your pre-approval update. Like, because if you were pre-approved last month and you think you can get approved for X amount, or, let's just say for 500,000, that might be not be the case right now, right? So we want to make sure that if you're still looking, that your pre-approval still is the same, the amount still the same, or that the pre-approval that was done was still active. But we are now approaching this at a more conservative side of things, that, okay, well, yes, you were pre-approved for that amount, but here's your monthly payment now. Does that still work for your budget? Right?
That's what I was gonna ask. Yeah,
Yeah.
because I was gonna ask it. We always recommend for our clients to get pre-approved, so we know the budget. That's one benefit of getting a pre-approval, is so we know the budget, we know what we can qualify for, and really to us, I mean, my thing before is that so you can lock in your rate. But does that apply? Locking in your rate if you had a pre-approval, that's not necessarily the case on variable, or
So for variable, rather than using the word locking in, is holding the rate.
reserving.
Yeah,
Reserving.
yeah. So if we're reserving the rate for you, the rate holds, as the terminology in our world. The rate that you can reserve is, something that protects you in case of the rate increases like this, right? So for variable rates, what's being reserved is the discount, right? So right now there are some prime minus 0.7 that we can reserve. But if you find a property right now, as of today, like, you can still get a prime minus 0.9, right? So it's the minus 0.9 that's being reserved.
Okay.
The terminology to use would be the rate hold, but the idea behind that is you're reserving that rate for you. There's no cost to that. It's free, and it's more to protect you as the borrower, right?
Oh, and so what you can qualify for, rather than just trying to go around and, like, I always say this is just like going for an X-ray. You're going for a surgery. I always use surgery. You're going for a surgery. You want to know what's behind there. You might be thinking about something else, and it's not what it looks like. So just double checking. It also makes your offer more stronger if you have a pre-approval, and it gives you more certainty on what you can get approved for, or what your budget is. And it also limits that. I mean, buying a home is already stressful, especially in this market. If you read the headlines, watch the news, they make it sound really scary. But by getting a pre-approval, you have more certainty, and also it lessens that anxiety, because you don't know if you're going to get approved or not. At least you have a better picture. You have a better what to expect. And by getting a pre-approval, for the most part, like in your case, you guys already check a lot of the things ahead of time. You talk about front loading. In this case, some people like, well, they ask too many questions and all that. Well, guess what? When you find a home, they're going to ask those questions anyways. The bank, this is why we know we're sure that we're going to get through this, because our system, the banking system, is so strong, because they ask too many questions, because they want to make sure that we don't get into anything that we cannot handle. Like, we know our capacity. The bank wants to know our capacity. So by doing this ahead of time, by getting a pre-approval ahead of time, you get to have a better understanding of what you can afford, and you don't have to go through the stress of providing all the paperwork. I mean, you may have to provide some for updates, but you don't have to go through the stress of providing all the paperwork while you're in stress. It's like you're swimming, and there's an emergency that you have to be a stronger swimmer. Now you don't have to think about the other things, because you already have it all ready to go. So anyways, I don't know if that was a great analogy, but I tried.
Makes sense. I mean, that makes sense, right? I mean, you kind of like basically learn how to land before you even jump, kind of type of idea, right?
Yeah.
So that there's no surprises. And also for us, we get a lot of common comments where, like, oh, you guys ask for so much documents. Because I'd rather have that up front than, send a client out looking for homes only to find out the surprises in the end, which might cause a decline by the bank because we didn't see it, we didn't know about it. So we're trying to minimize all those surprises on the client's behalf, just so that we're not wasting their time, your time, or anyone's time in that matter. and making sure that we don't also break their hearts in regards to like, hey, like buying a home is a very emotional process, right?
It's
And it's so
yeah.
discouraging when you try and all of a sudden it's the whole rejection side of things, right?
Yeah, yeah. Awesome. Well, if they have any other questions, I will do my best to put it in this video, your contact information, and it's Open Doors Mortgage Team. You can always reach them on social, on their website. And thanks again, Christian, for taking the time to
Thank you. Thanks for having me.
explain and clarify. And thanks everyone for watching. Hope this helps you have a better understanding of what it really looks like out there. Take care and we'll talk soon. Bye.
Thank you.